Hello everyone, Daniel from Infovest here. I want to do a quick video on this article that came out from CNBC talking about Target and Target expecting, basically the title says this, Target expects squeezed profits from aggressive plan to get rid of unwanted inventory. Ooh, so what does that mean, right? So let me share my screen here and show you what's going on this article, right? So here it is. And so looks like, Target came out and they're discussing about inventory issues, which is going to start squeezing into their profit margins. So here's some key points which summarizes the article here. Target said it will take short-term hit to profits as it cancels orders and marks down unwanted merchandise. Okay, interesting. CEO Brian Cornell said big box retailer wants to clear room for merchandise, including groceries and back to school supplies, right? Because still at the end of the day, you need food, you need to eat, you need your groceries. And as we, get back to school era, the season of back to school probably coming as we approach September, basically a lot of the big retailers want to take advantage of that to bring back sales higher, right? Or help with those profit margins. Now, Target anticipates its operating margin rate for the second quarter will be around 2%. That's lower than the outlook it gave less than 3 weeks ago. And the company also reiterated its forecast for sales growth and said margins will look healthier in the back of the year. So overall, when we go through this article and if we scroll down a little bit more, you see also from other retailers, a very nice paragraph here. Retailers from Walmart to Gap face a glut of inventory as inflation pinched shoppers skip over categories that were popular during the first 2 years of pandemic. And Gap, for instance, said customers want party dresses and office clothes instead of many fleecy hoodies and active clothes, right? Why do they want party clothes? Well, it's summertime and office gears looking like people are slowly getting back into the workforce as they realize that things are getting back to normal and they can't be staying home for as long as they thought they would. Now, Walmart said some families are making fewer discretionary purchases as the prices of gas and groceries rise. Abercrombie and Finch and American Eagle Outfitters both reported steep jump in inventory levels, up 45% and 46% respectively from a year ago, from a mix of items not selling and supply chain delays easing. Okay, interesting. So I'm going to comment on this in a second. We'll just go through this article a little bit more here. So here, Target is sorting through its inventory, deciding in some cases to pack away merchandise to sell at a full price in the future, and in other cases to promote or come up with ways to sell through it now. So here's the thing, right? With this whole COVID situation, with this whole supply constraints that happened in the past 2 years, right? And we're still seeing supply constraints still today, right? Even though it's starting to ease a little bit. A lot of companies out there, a lot of these brick retailer companies out there ordered a lot of inventory. And simply because there were shortages, right? So they went max out on buying a lot of inventory because they need it for the future. Now the problem is, right? As soon as they got that inventory, what the Fed was doing behind the scenes was basically raising or setting the tone for the market that they're looking to raise rates because they want to bring down demand. Right? When you look at what caused all of these supply constraint issues, of course, it was big component of it was COVID. But when you look at inflation, right, a lot of inflation and higher prices came from one, yes, the money printing, but most importantly, the supply issues that were happening globally, right? So this kept basically pumping up prices higher and higher because everybody needed something And since there was a huge demand and the Fed was printing money and people had extra cash, right, that fueled in additionally into this higher prices and higher inflation. Now, when you look at these big brick retailers, they went out, they also bought a lot of supply out there so they can have it in their inventory so that they could sell. The problem is now, after buying all of that and buying a load of it, of those inventory, now they're going to deal with an issue going forward because now you're having demand slow down because you have the Fed raising rates, you have tapering that have started, right? The balance sheet runoff has started this month. So that's of course going to affect into corporate earnings. It's going to affect a lot of these big brick retailers, right? Especially Target. Target came out just not long ago with its earnings announcement, which really shocked the markets, and you saw Target sell off right aggressively as soon as the earnings numbers came out, and they came out again talking about, hey, we want to update everyone that we are feeling the squeeze with the inventory because we ordered a lot of stuffs thinking that we would get it off our shelves, but looking like as prices continue to rise, consumers are being affected by inflation, rates are starting to rise, balance sheet runoffs are happening, mortgage rates are rising, people are feeling the pinch, oil prices are rising, people are feeling the pinch, right? So where do corporate earnings go from here? Where do stocks go from here? Where do all these brick retailer companies go from here, right? They've got really no choice other than if they can hold it on the inventory, maybe for next year. But I think what it may look like, the second option, which seems more feasible, is to come up with some sort of promotion to either sell those goods at some sort of discount or give some sort of buy one get 50% off on the other, some sort of promotion in that sense, which is basically again a discount because you're lowering the prices because you want to get it off your shelf so you can be prepared, like Target said, for groceries and other things, like back to school supplies as well. And it's interesting that Target mentioned groceries as well, right? And why would they mention groceries, right? Of course, groceries is a big component of the sales, but could that hint towards, which Target is not mentioning, the food crisis that is currently happening and the supply shortages that we might see coming close, maybe in the summer months or maybe by September, where we see these massive food shortages like we've seen with other goods, right? And then other products, just we're not going to see it with other products. We just might see it more with food and essentials, which is why Target is preparing for that. So if they're preparing for that and they're bringing in inventory now with food, if you bring in too much inventory, right? And there's not really much of a supply constraint there, then you can't really hold on to food unless maybe you freeze it in the back storage and then sell it after a year, which would probably be not the ethical thing to do. But hey, you never know what happens in these stores. But not saying that they do that, but I do believe that a lot of if they do plan to do that with food, then you could probably see a lot of losses in that sense if the food shortages don't end up being that's playing out how maybe these brick retailers are seeing the food shortages in the future. Now, I do feel that that's what's coming up next in terms of the food crisis and the shortages, which is why again consumers are feeling the pinch, right? They're making decisions whether they should go and purchase that hoodie or they should allocate that money towards again food, and making a decision because oil prices and gasoline has been skyrocketing so much, so they're moving on to maybe lower type of brands, right? So which is causing more of the issue. So if this continues to be the theme, definitely you can see corporate earnings. And like they've warned us, right? They've already have told us, so it is priced in that it's expected that they are going to feel the squeeze on their profits. They're probably going to cut costs with cutting hiring and cutting jobs out so they can lower their cost. And especially if demand really dampens and if rates continue to move up, yields continue to move up, 30-year yield in the US bond continues to move up, mortgage rates continue to move up, there'll be less discretionary income, less income on the side for someone to go out and purchase other goods and services. So what do? Right? The inventory that's sitting there that no one's buying and you bought a lot of it, what do? You either sell it off now with some sort of promotion or a discount, or you wait till the next year. And I think what most companies will do is sell it either at a discount or at a loss to get it off their inventory, which might be good for some people because if you're looking to purchase whether some sort of goods or some sort of product that has been quite expensive during 2021, you might find discounts coming this year in 2022. So that might be a plus for a lot of consumers. But again, if you don't have that money and that enough discretionary income, then it'll be quite difficult to make that purchase. And you'll find a lot of people in the same boat where they will be making decisions on their income and allocating on what goods to buy and what not to buy, which then will possibly lead to two things: some sort of massive dip and crash in the stock market if we start to see these prices continue to be elevated and we start to see something break in the economy. And if that happens, right, what will that mean in terms of the Federal Reserve, which is on this rate hike cycle, right? What will that mean in terms of their quantitative tightening? Well, if something crashes and something breaks in the economy, you can definitely bet that the Federal Reserve will start to paint a narrative and a picture on now cutting rates, right? And you can see that when you look at bonds and when you look at the euro dollar, you can see it start to price in the coming years that rate cuts are now to be expected after we go through this rate hike cycle. And I think with what everything is panning out, how everything is panning out, how everything's playing out, and if you really dampen demand, that will definitely trigger into prices coming off, and you're seeing retailers lowering their price, which would help inflation come down, which will then in turn also affect the suppliers on the supply side, right? Which would mean that these retailers, these companies, right, that are going out and purchasing goods, they will be purchasing less. And those suppliers will also want to get their inventory off their hands because they might be paying for having that inventory sit there and they're not making any money. So what will they do? They will also eventually lower their prices to push that inventory off so they can sell it to these retailers or these companies and these businesses so that these businesses can also sell to consumers, and which will also bring lower prices and lower prices to the consumers, and you'll see prices drop drastically, which could bring inflation down, which would be the central banks globally their target, as majority of the central banks around the world are raising rates with the goal and with the mind to lower inflation, right? Because you can't really control the virus. The Fed can't go out, the central bank can't go out and dictate and decide what to do when it comes to lockdown measures that the government has, or what China is doing, or the supply constraints, or the war between Russia and Ukraine. So that poses another opportunity, or another, I would say, a trade, or not a trade, but another shift. That's the better word. Another shift in the economy and in the markets, where you might start to see prices come down. And as prices come down, and as demand also is softening, and as possibly also GDP heads into negative territory, and as something breaks in the economy, definitely the Fed will probably, hold back, and you might hear a new narrative coming from the Fed about, hey, let's start cutting rates, or let's start accommodating the markets, or doing something, since we are now approaching our inflation target and prices are coming down quite a bit. So watch out for that. Watch out for that from the Fed. Watch out for that in the next couple of months. I think in order for us to get proper direction, this next couple of months is going to be quite important when it comes to looking at data. So data is going to be huge. You want to see how data comes out in the next couple of months in terms of the economy. You want to see how the communication comes out in terms of the Fed, right? The Fed is coming out next week. They're going to discuss about many things, and they're going to have their projections and their dot plot and everything. So that's also going to be quite important when we look at where their direction is with the rate hike cycle, right? A lot of people are betting that they're going to continue with the 50 basis point rate hike even in September. And then you get the other half of the people betting that, they are going to slow down, and the slowdown is going to come, and we're going to start with, we're going to go from 50 basis point to 25 basis point, which may set up for possibly something breaking in the economy, and then the Fed flipping to saying that, okay, we need to start now accommodating the markets. So let me know what you think about all of this, the inventory issues, the supply, the demand, the prices. Do you feel inflation has peaked? Do you feel inflation will continue to move down? And what will that mean in terms of a lot of prices and goods that you're buying today? So let me know what you think. Comment below, and I'll see you guys around. Good luck. Bye.